This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Steve Saretsky here. Welcome back to the show. We got lots to chat about this week. We've got an update from the Fed, the world's most important central bank, how that's going to impact financial markets. Of course, obviously loving it. Talks of the pivot, the end of the bear market in Canadian housing, hearing more and more on that. So I want to chime in with some of my thoughts, anecdotal stories, what we're seeing, boots on the ground here in Vancouver, some of the data that is going to discuss around that, talks about, cuts from the Bank of Canada later this year. And of course, the signs of the labor market that are still concerning me. So I really want to touch on all of that. But we have to start things off on this week, really talking about the Fed. Again, Jay Powell, the most important central banker in the world, coming out, raising rates 25 basis points as expected. So the pace of rate hikes is now slowing, similar again in line with the Bank of Canada last week, obviously raising 25 and saying that they're now on pause and going to reassess. Jay Powell had some different comments, in fact, saying that he's now diverging from the Bank of Canada. So let's clip to that right here.
When you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing, but this is not something that the Federal Open Market Committee is on the point of deciding right now.
So unlike the BOC, Jay Powell says, listen, we are going to continue to raise rates. We still have some room to go. So we're not going to pause to assess and then, think about raising rates again, maybe sometime down the road. Jay Powell wants to keep going. So basically the expectations are for 2 more rate hikes from the Fed, 2 more hikes of 25 basis points each. Of course, the markets are trying to call Jay Powell's bluff and saying, well, maybe it's only going to be, 1 more at 25. So you saw this sort of rip in the equity markets, and we're seeing that in various housing markets through my conversations of various people in the U.S. We're seeing, an uptick in housing activity there, obviously with mortgage rates coming down in the U.S., but also a growing chorus of people here in Canada calling for the end of the Canadian bear market. This has already been the largest sell-off on the National Home Price Index to date, since the index was created, of course, back in 2005, which we've touched on many, many times. So is this really the end of the bear market? Basically, people are coming out and saying, well, listen, the Bank of Canada is on pause. The worst of the rate hiking cycle is behind us. People now have some comfort, some clarity to re-enter the market, knowing that this is pretty much where we're going to stabilize. Again, very hypothetical. That fixed rates that were now, were previously about 5.5% are back down to under 5. You're looking at a 5-year fix today at 4.99, 4.89 if you know somebody. So people are now, again, the narrative is growing that this could be the end of the bear market in housing now that people are re-entering the market. And we're seeing, calls in the swaps markets for the Bank of Canada to actually cut rates 50 basis points at some point this year. So I've got a few thoughts on this. What we're seeing right now, anecdotally on the ground, I'm hearing this in the GTA. I'm hearing this, I'm seeing it in Greater Vancouver, which is we're seeing an increase in activity. We are seeing a lot of houses that were on the market for 3-4 months suddenly being under contract, suddenly selling, sometimes even getting multiple offers after sitting on the market for 3 or 4 months. Houses that are coming to market as brand new listings, are selling in 7 days. And again, in some cases, ending up in multiple offers. So everyone's going, wow, there's this, all of a sudden I'm back to, competing for real estate. This is a very foreign concept over the past 6 months. Is just this big uptick in demand that is now, again, the narrative building around the end of the bear market? Well, I want to caution people because I think we're reading in way too soon into 4 weeks of data. Again, you guys know that I've pushed back on, the overly pessimistic, bearish calls for, 50% collapse, housing until it gets back to local incomes. It hasn't bottomed. And, you guys know that I push back on that BS. And I'm equally going to push back now on some of this hype bullish narrative that is building, because if you really unpack the data, Greater Vancouver home sales for the month of January were the lowest they've been since 2009. Again, this isn't adjusted for population growth or the increase in housing stocks. It was a very weak month. So the lowest home sales since 2009. That doesn't scream, raging demand to me. That's not a great number. Now, the problem that we're running into is really an inventory problem. If you look at new listings, it was the lowest number of new listings since 2004. So how do you really draw any real conclusions in the market when you've got sales running at decade plus lows, multi-decade lows in new listings? You kind of in this weird sort of fake market where there's just not a whole lot transacting. So it's much too soon to say, hey, based on 4 weeks of activity and based on, nothing coming to market, we're now out of this bear market. What I will say is that if you look at the current levels of inventory right now, that's just standing inventory that's on the market for sale for you to go out and buy. The levels right now are extremely low. In fact, if you go back over the last 10 plus years, anytime we've had this level of active inventory for sale in the market, it has been a bull market. You've seen double-digit price growth based on the current levels of inventory. Now, of course, we're not seeing double-digit price growth today because, again, the demand is still weak. It's still not what it has been in the past. And so this isn't going to really change a whole lot until we get either demand actually genuinely picks up and you start to get more and more people off the sidelines, maybe rates come down a little bit more, or new listings ramp up and things balance back out. And so I'm struggling because I think we're going to get that usual uptick in the spring market. We always do. We always get the uptick in March, April, May. That's when your seasonal increase in new listings comes. Now, is it going to be enough to push inventory levels from where they are, which is incredibly low, to suddenly oversupplied in a span of 2, 3, 4 months? Unlikely. So I think you're probably going to muddle through the spring market. That's my personal guess. I think the good product will probably go in multiple offers just because there's not a lot of decent inventory. So I think what you can argue is that over the next 3 to 4 months is that you should see relatively stable prices. Now, again, I'm hearing calls from some of the big developers in town, other people that I respect in the industry saying, "Wow, again, this could be a bull market. We could see double-digit price growth." And I want to caution people here because I really push back on this narrative, which is central banks are doing everything they can to fight inflation. They've raised rates. This is the fastest tightening cycle, more so than the 1980s when you adjust for the level of private debt loads in this country. So what they're trying to do is they're trying to basically they're trying to push asset prices lower. They're trying to create a reverse wealth effect that will stem demand and basically rebalance supply and demand. They've come out and basically have told you this several times. So the same people that are saying, listen, we're now in this housing potentially bull market. And by the way, we think the central bank will cut rates 50, 75 basis points. I heard one, I'm not going to name the name, but a big report out there, big name in the industry saying we expect rates to be cut 75 basis points. And I'm going, well, why on earth would the Bank of Canada, that's trying to fight inflation, cut rates 75 basis points this year if house prices are going up? if anything, if I'm a central banker, that would make me incredibly nervous. In fact, there was a bunch of reports out in the past couple weeks and months that has shown that the wealth effect from rising house prices during the pandemic was a result of like 2/3 of the overall inflation increases. And it was a huge contributor to the amount of people leaving the labor force. So people are saying, I don't need to work anymore. I'm going to retire. I'm 60 years old. I'm going to retire 3, 4, 5 years early because my house is up. My equity portfolio is up. Why do I need to work? I can just live off these paper gains. And so that's what they did. So the central banks are actually trying to engineer a recession right now. They're trying to engineer a soft landing where they can get an increase in the unemployment rate to bring wage pressures down, to bring some slack in the economy, and to basically give the all clear on the inflation picture. So again, careful what you wish for, because if you're calling for or hoping for the bull market in housing or the end of the bear market, it just means higher for longer from the central banks. They're just going to be less reluctant to cut. And so I think, we talk about all these people that are facing issues with their variable rate mortgage. They're going to continue to face these pressures because it just gives no excuse for the Bank of Canada to start cutting rates if you've got, house prices accelerating in 2023. So that's my contention here. I think that there's a misnomer. I think people are way too optimistic. I think it's way too early to proclaim success on inflation. Don't get me wrong. I think it's coming down. If you look at core inflation, it's back on a 3-month annualized pace. It's back within the Bank of Canada's target range, but it's too early to be waving the victory flag and doing the happy dance and saying that it's okay if house prices start accelerating 5-10% this year, that we're not going to have a re-emergence of inflation like we did in the 80s when you had that second wave of inflation. So if that happens, look out, because I think you're going to see more pain from the central banks. And, funny enough, as everyone was kind of doing the happy dance over the last few days, we had this monster jobs report out of the U.S. In the non-farm. I'm going to butcher this. NMF. Anyways, the payroll survey in the U.S. basically, I think they had projected at 188,000, and it came in at like a blistering 500,000. It was like the largest job gain increase since I think the early days of 2022 after the sort of the pandemic, as people were getting their jobs back. So this is not what the Fed wants to see. They need to see some slack in the labor market. They don't need to see a blistering jobs report as they're trying to basically engineer a higher unemployment rate and slow the pace of wages. So, and again, so long as asset prices go up and people are feeling better about, the outlook, that allows them to cautiously reinvest in their businesses and to retain employees, etc. So we'll wait and see, but this is the kind of seesaw that we're talking about. It's a very difficult market to predict. So I'm very cautious about predicting, 6, 8, 12 months out. But I think in the near term, you guys have my outlook and my thoughts on the housing market. So see you next week.